If you're planning to start Social Security in the next few years, there's a new wrinkle that you need to think about, and it has nothing to do with your benefit amount. Today, I'm going to show you how the new senior bonus deduction, the extra $6,000 deduction per person, should be partially factored into your decision about when to file for Social Security. This is a temporary deduction. It's only available from 2026 through 2028, and it's designed for people who are 65 and older. But here's the thing, you don't automatically get it. The full deduction is only available if your income stays under a specific threshold. And for a lot of retirees, starting Social Security could push you over that line, especially if you're planning to do any Roth conversions, or you have a large pension, you have a big capital gain coming up, or really any kind of short-term income sources that are taxable. So, in this video, we're going to look at how your filing decision affects your eligibility for the deduction and why delaying Social Security might help you to save on taxes, and how to make sure you don't accidentally miss out on a 4-year tax opportunity. So, the new tax bill that was just signed into law didn't change anything about Social Security directly, but it didn't have to, because even without touching Social Security directly, it introduced a new deduction that can have an indirect impact on a filing decision. And that's something we talk about a lot here. The idea that Social Security decisions can't be made in isolation. They have to be part of a broader, more comprehensive plan. And today's topic is the perfect example of that. Filing for Social Security isn't just about your benefit amount, it's also about how that decision fits into your overall picture, especially your tax. And now that there's a bonus deduction on the table, it's even more important. And this is exactly why software alone can't always guide you to the best decision. You need to zoom out, look at your full income picture, and understand how each piece interacts with all the others. So, I've already covered the $6,000 bonus in another video, so I won't rehash all the technical details here, but if you want to dive deeper into that, you can find this video in my channel. But here's the big picture. For people who are age 65 and older and have their income under a certain threshold, there's a new tax deduction of $6,000 per person available for tax years 2026 through 2028. That means for a married couple who qualifies, this could add up to nearly $50,000 in total deductions over those 4 years. But this part is critical. To get that deduction, your income needs to stay below specific levels. For single filers, you qualify for the full deduction if your income is below $75,000. Then from $75,000 to $175,000, the deduction gradually phases out, and once you hit $175,000, it's gone completely. For married couples filing jointly, the full deduction is available if your income is below $150,000. And from there, the phase-out range runs up to $250,000. And at that point, you're fully phased out and you lose that deduction as well. So, this is not a cliff bracket here, where you lose everything at $1 over the line, but the phase out is pretty steep and the tax benefit shrinks quickly once you go over that limit. Now, the big question is, what is the number that they use to determine your income for purposes of this phase out? Because it's not just your gross income and it's not your taxable income either. For this deduction, the number that matters is something called modified adjusted gross income. And for most retirees, this is the same as your adjusted gross income, but maybe with a few important wrinkles here. Your AGI includes things like IRA withdrawals, pension income, dividends, capital gains, rental income, maybe wages if you're still working, Now, here's where this ties into Social Security, because AGI also includes the taxable portion of your Social Security benefits. So, even if you think you're living on a modest amount, your AGI might be higher than you expect once your Social Security kicks in. And calculating this can be a little tricky. And there's a weird feedback loop here. You need your AGI to calculate how much of your Social Security is taxable, but you can't finish calculating your AGI until you know how much Social Security is taxable. And that's the loop. Your income determines how much of your Social Security gets taxed. And that taxable portion then becomes part of your income. So it's a weird circular calculation where small changes in income can lead to big jumps in taxes because they push more of your Social Security into the taxable column. Let me show you an example of this. And to keep this clean, I'm going to strip it down to the bare basics. Let's say a couple has only one source of income, Social Security. Their household benefits are $60,000 and they have nothing else coming in. Because of the way Social Security taxation works, and because they have no other income, none of their benefits are taxable. That means that their adjusted gross income is actually zero. But now, let's change it up. Let's say that they decide to take $70,000 out of their IRA. That additional income triggers taxation on their Social Security, pushing it up to where 85% of it becomes taxable. As a result, their adjusted gross income jumps from zero to $121,000. Now, this is a classic example of what's often called the tax torpedo. And now that we have this senior bonus deduction, it would be surprisingly easy to push yourself over the income limit without realizing it. So, how do you keep from accidentally pushing yourself over that income limit and losing the deduction? Well, one of the most effective levers that you can pull is delaying Social Security. When you delay, you're not receiving that income yet, which means that none of it is showing up on your tax return. And that gives you more control over your adjusted gross income during those retirement years where the senior bonus deduction is in effect. Now, those of you who have followed me for a while know that I'm not in the camp of people who say you should always delay Social Security as long as possible. I don't follow that rule of thumb advice that says that everyone should wait until 70. I think the right filing decision depends on your plan, your numbers, the goals that you have set. But this is one of those situations where delaying really might make sense, and it's something that needs to be tested. If delaying helps you to qualify for that $12,000 tax deduction times 4, that could change the equation. It's not just about maximizing your benefit, it is about minimizing, though, your taxes and keeping more of your money. In fact, this is one of the only times in retirement when you can fully choose which income sources to tap into. If you delay Social Security, you can live off of cash savings or even take a smaller controlled IRA withdrawal that'll help keep your income below the threshold. Although, it would work best if you had other savings in those taxable sources. And doing this could help you qualify for the full $6,000 deduction per person and could also give you more room to do strategic tax planning like Roth conversions while still staying under the limits. Now, I had a lot of examples that I was going to pull into this video, but by the time I looked at all of the things that I was supposed to cover, it was already too long for that, and I didn't want to layer in a bunch more examples. And I know in the comments I may be crucified because everybody says, well, you didn't talk about this, you didn't talk about this, and you didn't talk about that. The videos just aren't long enough for me to talk about everything that I need to. But, the key idea here is that once you start Social Security, you lose some of that flexibility in creating your own income stream. A portion of your benefits are likely going to be taxable. That's automatically going to raise your adjusted gross income. But if you delay, you're going to be able to keep that door open. And for some people, this could be the difference between qualifying for that deduction and not qualifying for it. So, delaying Social Security is not just about increasing your monthly check, waiting for it to grow. It's also potentially a powerful tool for managing taxes during what we now know is a window of opportunity. Ultimately, I don't know if it's going to be worth it for you to delay Social Security or not. That's going to depend entirely on your personal situation, your mix of savings, how much flexibility you have with your income, and whether you can choose when and how to pull from different account types. But in the right scenario, this could make a sizable difference. It's not just about squeezing more out of your Social Security benefit and maximizing it. It's about using timing as a tool to keep more of your retirement income from going to taxes. Thanks so much for watching.